tell the audience about how you got started in real estate.
Welcome to the Masters in Real Estate podcast with your host, Tanner Webster.
So we'll start off with the trend over the last couple of years has been stay away from the blue states like Illinois, California, New York, and you are investing in multifamily apartments in Chicago. And so I want to hear why you're doing that.
Yeah, I think, thanks for having me on, Tanner. It's, first of all, it's where I had lived until last year for 12 years. So I think real estate's really local. And I think you can find good deals in any market. So someone really smart told me you can find good deals in bad markets, bad deals in good markets. There's good deals in any market, whether that's like the market cycle or the city that you're in. And I don't even think Chicago is a bad market. And I just think that a lot of these blue states and cities, the baby gets thrown out with the bathwater and people don't even really look into it. Like you look at Chicago and you think, okay, like I have these conversations all the time. Like, oh, wow, how does that work with like the rent control and all this stuff? And well, there isn't rent control. It's maybe if in New York or California, like some of those things are, you need to be more careful what kind of stuff you buy. But yeah, in Illinois, there's no rent control. And there's a big property tax headline risk on all these deals. I think that you need to understand how the taxes work. I mean, I think any deal, the main three things that drive the deal are your starting rents. I guess the rents are going to stabilize too. Property taxes and your exit cap. I mean, those are the three biggest assumptions. I mean, in multifamily, at least. I think in probably a commercial deal, the property taxes, if tenants are paying them, probably would be the third most important. But I think if, on the deals that I've owned, and I bought my first deal in 2013 in Chicago, and I bought, I think, almost 30 properties there since. So I don't know the exact number, but we've only had really one time where the taxes went above what we underwrote, where we're underwriting the deals, assuming an increase to the level our property tax attorney says, like, this is where I'm getting relief to conservatively when I go in and appeal. So you in Chicago, you get reassessed in Cook County every 3 years. And if you don't like the value you're given, you can go appeal it to the assessor. But also if the assessor says no, or you don't like what they give, you can bring it to the board of review, which is a different group. It's got 3 commissioners on it. And you can get relief there. If you don't get relief at the board of review, you can do a lawsuit in circuit court. And so you can get your taxes knocked down. And so what we're doing is we're underwriting basically to like, here's where our attorney is routinely getting the taxes down to. But most of the time, the taxes don't even get to that level. Like we get it and we go, hey, this isn't so bad. Let's just leave it. Or this is already under our underwriting, but let's just appeal it. I mean, anyways, frankly, see if we can get it relief. So we've only had one where it went beyond where we underwrote. So then if you think, okay, don't invest in Chicago because the taxes, but then here's a guy who did 30 deals and only 1 out of 30 has gone worse than he underwrote. I mean, most people in probably Texas or these other places where taxes go up a lot couldn't say that it's gone that well, right? So,
and I'm assuming the insurance is significantly better in Chicago than it is in Texas, right? With all the hailstorms and stuff like that. So it really feels a lot more like an operational thing than a market risk. Like if you know what you're doing in Chicago, you'll probably be fine. Is that the safe assumption? Or
it is, and I really think that's possible in any market. I mean, we know people that are, on Twitter that do deals and what seemed like the hardest market to make any money in LA, like in terms of and they figured out a blueprint that works for them and they can make money. And it's because they have all that local expertise where they're buying deals and seeing people making mistakes and this and that. And so I think where we've done well in Chicago is really knowing what the rents should be at that building. And just as you do more deals in an area, that knowledge compounds, where you go and you look at it and go, wow, this the deal we bought at the end of last year, they were renting brand new 2-bed, 2-bath units for $3,100, which seems like a lot of money, and it is.
Damn.
But for that area,
yeah,
it's way under market. We bought a building from them that was built in 2016. It's 3 blocks closer to downtown, so the rent should be a little higher, but not $500 higher. But we're getting $3,650 at that building. So we underwrote we'd get them to $3,300, and with that change, and then adjust the taxes to your post sale valuation, we think we can stabilize that at a 7 cap, a 3-year-old building. Like, why would you not buy that deal? We went 5 years interest only, 5-year fixed rate term at 5.53%. I mean, that's a lot of positive leverage. We've been paying out 8% cash on cash since we bought it. Why would you not do that? I mean, all of our deals aren't like that. I mean, that we got real fortunate with the timing and the loss to lease on the rents and the vintage and all that. But if that's the profile, why would you not do that deal?
And I'm assuming you're doing all market rate stuff. You're not doing any are you doing any affordable, or is it all market?
It's all market rate. People make money doing affordable. I used to work at an affordable developer, and that's something that I do think about getting into again, but that's a lot different animal than what we have been doing. Our bread and butter has been buying, at least in Chicago, stuff built since 2005. And that wasn't initially like, hey, here's our criteria, but this is how it just worked out. Like a lot of just broken condo deals initially, they built them to sell as condos in 2007, 8, 9. And then foreclosure, bank leased them out, and then we're picking them up on super low rents with a lot of loss to lease. And then when that dried up, we pivoted to buying deals from, usually seem like brand new deals from developers where they had a rough lease up. Like if in Chicago, the leasing is very seasonal. So if you have to rent out, especially larger units, so let's say 2 and 3 bedroom units in the winter, rents could be 20% below what they are in April, May, and June.
Is that, I'm just assuming weather, right? Like people are moving
weather,
during the summer
and then
because it's so cold.
Yeah, weather, schools, and also when colleges are graduating, because most of our deals don't have people fresh out of college in them, but that just puts so much more demand on the market because a lot of people from all these Big Ten schools, their number one choice to move to is Chicago. If you're from Wisconsin or Minnesota, Indiana, Iowa, or Michigan, most of those people end up in Chicago for their first job, and they all graduate in May. So
you're in Chicago, and you also mentioned kind of Big Ten schools of Wisconsin, Minnesota. You're also investing kind of all along the Midwest, right?
Yeah. So this, what's interesting, just kind of make sure that, I've been investing. Initially, I grew up in Wisconsin. I bought my first deals in Madison. Then I moved to Minnesota for a job and was buying deals there while I was working and with my investor that I met there. And then we started buying in Chicago. Like that's like the history. And then late in the game, we thought, all right, let's participate in the Sun Belt. And then we started buying deals in Phoenix in 2021. And then in 2023, I moved to Austin, Texas. So our office is everybody who works for Breneman Capital and our property management company is in Chicago. I moved to Austin, and eventually we'll get an office going here as well to participate in the Sun Belt. But in the Sun Belt has a lot is still softening, and there's so many deals that are over levered where they need to work something out, and those need to clear the market. But the Midwest, rents are still increasing, and there wasn't all this like floating rate short term business plan stuff going on. So yeah, we have had just year after year of really solid rent growth in Chicago now. And then we look around where we developed a model that's we call it our market outlook model. And what it does is we got data on the 52 largest MSAs on population growth, job growth, home price values, apartment values, apartment rents, just everything that would have an impact on apartment appreciation, supply in a market. And we went back and figured out what was correlated. And this, I didn't make this. One of the guys who works for me, his hobby is sports analytics, and he made a NCAA bracket optimization model, he calls it. And what it does is you can 5 times your chance of winning your NCAA bracket pool with his model, because you can figure out what's correlated with winning and losing in head-to-head matchups. So how correlated is the pace of play, or the 3-point percentage, or what have you, or how many points they score. And so we did the same thing, but going back and looking at the markets, and we measured everything relative to the national average of appreciation. So like the score it spits out is all relative to the national average. So we're not able to necessarily predict like, hey, next year Chicago is going to go up 5%. It's more just based on our model, it'll go up above average next year, the year after, but also it has way above average cap rates. So then that sounds pretty good. And then using that same model, a lot of these Midwest markets were at the top of our model now, whereas 2 years ago they were not. The model was, if you go back and look at what things were on track for in 2021, it was Phoenix, Tampa, Miami, Dallas, Austin, all the high growth ones. But now when we type in the data, what's going on with vacancy, rents, everything, those Sunbelt markets are all towards the bottom. So with the Midwest at the top. And because we realized that one of the things that's the most that drove the model the most was the rate of change on a lot of these stats. And so you have had such aggressive, deceleration, or really just even turning the negative on rents and occupancies and everything in the Sun Belt. So yeah, Midwest. And so we're also, buying deals in Madison, Milwaukee, and Indianapolis. So not everywhere in the Midwest, but again, I think it's really because you got to understand the markets. So you can't be in like 20 of them. It's a hard enough being in 4, and then also keeping your ear to the pulse.
Yeah,
I know. Yeah, yeah, right. We're mostly in Chicago, but then we're especially Madison, Milwaukee, where I've lived in both those places. We're really that we already know like what the nice areas are and have like a good handle on what's going on there.
Would you say your business plan is different in the Midwest than it is in the Sun Belt? Like in the Sun Belt, are you trying to pick up distressed deals, and in the Midwest, you're trying to pick up maybe value add, or maybe a light value add, or a core? Like what do those business plans look like, if they're any different?
Pretty similar to what you said. Yeah, we're in the Midwest, we're more or less, we're buying deals that have some element of value add, but it's not like a gut rehab type thing. It's really just it's like the example I gave, where the rents are significantly below market. Or a deal we did a lot of before was discounted purchase price because it has a loan assumption, but that was back when loan assumptions, when interest rates were, you're assuming a above market interest rate loan.
Interesting.
Because that in 2019 I did one, and in 2020 I did 2 loan assumption deals. And what was going on was, interest rates were in the 3s, and these people had high rates in the 4s. And so then, they had, so significant yield maintenance. I know, that's why I'm smiling, is because this is kind of funny how things work out, right? Where they ended up being on one of these deals the only bidder, where somebody wanted, they took it to market. They're trying to get $16.5 million for this deal. They couldn't get it, and this was assuming they'd sell it free and clear. And then the broker sent it to me and was like, I know you do all these agency loans. Like, what could you pay if you just assume the loan? I'm like, oh, 13 million is my number on this one. And that's partially because the loan was maybe about 1% above market, but also just like, I didn't think the deal was worth 16.5 to begin with, but let's say I thought it was maybe, I could have got to 14 something. But anyway, so we ended up buying it for just the 13 million plus the broker fee. And and because we're the only bidder, and it was, what did we underwrite it to? It was like a 17 IRR, 3.3 time your money in 10 years. Like, sounds good. And we got it. And that was, the second or third building I had bought from that guy. So he knew we'd close it. And they had kind of lost track of some stuff at the property, what was going on, like the parking. They didn't know who was renting where, who was paying what. So it was like, had a really nice potential value add story. It was, it was being not really run the best. The guy's a great developer, but then he's not as much of an operator seemingly, but they great to buy from. But they were so that, like, those types of deals are kind of the profile we're doing in Chicago. But then if that comes up in the Sun Belt, yeah, I'd love to buy it. It's just what happens is in Chicago, that deal today might be, or let's say when things are really crazy, just for fun here, 3 years ago, that deal I'm talking about would have been maybe a low 5 cap, and then you see that deal in Texas or Phoenix, and it's a 3 cap because it's a newer, nicer deal with loss to lease, and so it doesn't make any. Those deals never made any sense numbers wise. The deals we did buy in the Sun Belt, yeah, they were all, you're going in at a low cap rate, but you're stabilizing to about a 5 unlevered yield on cost, which sounds pretty good if things are selling at 3 something caps. I mean, obviously now with the market moving to 5.5 to 6 caps, those deals are not, those are all be our worst deals. I mean, just to be honest, like those will, the 5 deals we bought in Phoenix, those will be 1 through 5 on probably the lowest returns I've delivered to date, just where we're so many moving pieces on those deals, which I know, and I talk about to people on deals they look at, because people will be looking at something and say, hey, this looks pretty good return wise, but it's like they have to do so much to the property. You got to buy it, you got to renovate it, you got to refinance it again, you're doing the floating, your variable rate interest loan. And so I just but I got caught up in all that, and we, at least we were stabilizing to really solid yield on cost compared to what we're seeing other folks do, but it doesn't matter. It's still, those still been all tough deals. Thankfully, 4 out of the 5 were fixed rate on the Phoenix ones, where we did fixed rate bank. So we're at 3.5% interest, but it's just, you're still stabilizing to less than like today's value. So it doesn't feel so great. But we just got,
I wouldn't be too mad if I was you. You don't lose money till you sell. So you're good for long time. Like, who knows what market's going to look like? Phoenix has got a lot of growth, so I think if you're fixed, then you're probably good. So
yeah, I was in a similar scenario in 2009 where I had on this initial properties I had bought, I had one that I was considering selling, but I could have just basically sold it for the loan amount. I kept it, and I ended up selling it for like 60% more than that value in 2017. So it was like, it really turned around.
That's
it
pretty
was
good. Yeah.
So no, I'm glad that's I know sometimes when I'm if someone wants like something to talk about for like beginning stories, they'd be like, here's how I made $1 million on a 3 unit but it's over 10 years, and it was I just constantly reinvested all the cash flow on that one to improving it. So it went from something where people were just student rental punching holes in the wall because I wasn't cleaning the hallways, to like having stainless appliances and like a nice light gray paint on the walls, and mom's hanging wall art up that says like love now on the walls. So totally changed the deal.
For all our listeners at home, all you got to do is slap some gray paint on it, hold on for a while, and you'll make money. So that's it's great.
Yeah, and have a long enough loan term. That's yeah. So
good spot to transition. How are you typically financing these, both debt and equity? Are you family office, high net worth, friends and family, agency? How does that all work?
Yeah, it's all so on the financing, it's been all agency. And I guess, initially I was also buying, before I started specializing in multifamily, I was buying commercial properties, so shopping centers, office, industrial. That was all bank financing. But yeah, today it's all been Freddie SBL for anything that's like under, at least in Chicago, 7.5 million is the loan limit. Like that's a very streamlined, great program for people to use. Yeah, and then Fannie and Freddie, just conventional size on the other stuff. On every deal in Chicago, it's been done that way. With the agency loans, even if it's like a value add deal, we just do the refi out of cash, equity that we raised. This is already like pre-funded or factored in, where we're going to reinvest some of the cash flow into like the tail end of the renovation. Those Phoenix deals I was talking about, 4 out of them were with the bank, and then 1 was with a debt fund. And then that would be the one where if we have trouble, it's going to be that one, because it has the shortest loan term. So you don't, time's not our friend on that deal. And then on the equity side, started out, I just had one investor. I was a coworker's dad that I had met when I was up in Minnesota. And then from 2009 to 2019, he was my only investor. He invested about $8 million and just parlaying that from deal to deal. And not all at once, it was $2 million one year, then 2 the next. And so what we were doing is we would acquire a property, raise the rents, and then refinance out all the equity.
Good strategy.
I mean, yeah, it is when things are, when the market supports it and, everything's still on its way up. If you, the negative to it is if you have everything levered to the max, you're not going to have that much cash flow, or, if the, market drops 20, 30%, you'll have not, no equity in your building. So I wouldn't recommend that on every deal, but we were doing that in just a portion of them where we weren't doing that on most of the commercial ones. Those we would buy, over time, increase the rents, and then just leave it alone and cash flow it, or sell it and then roll it to a bigger one. We did full cash out refis in 14 deals in a row. 12 of them were the apartment ones in Chicago, where on average we refied out over 100% in 22 months on average. So we had a really nice run, and that was just recycling his money. And then in 2019, I started taking on other investors, and it's been all individuals so far, except some individuals that are big enough that it's family office money. Like the deal we bought at the end of last year, one family office came in for about half the equity, and then another individuals, but not a lot of the like small like checks. I guess like a lot are $500,000 or 100, and then depends on the deal. Our minimum is either 50,000 or 100,000 depending on what we're doing. So,
and how have you kind of gotten to know these people? Because I think a lot of investment managers, the biggest constraint for them is either capital or deals, and it's usually capital. So how did you expand that? Were you doing active marketing? Were you just calling people, putting Facebook ads? Like how did that expand?
Yeah, no, that's a great question. I'd be happy to go through all of it, because I haven't talked about this and people would be surprised. Like I have my own podcast, and I had talked to you when you were on it, and
my first podcast appearance. Yeah. It was great. So
nice. That was actually your first. That was no, you did great as a guest. Or okay, nice.
Thank you. Yeah. Thanks.
Yeah, they are. I don't think I've got any leads from that. Which I know surprised you, but I don't, at least not when I say, how'd you hear about us, where they say the podcast. And I did. And so I'd say, I have a podcast, but that has not been, that's towards the bottom for lead traffic. I mean, I'm sure someone's came in somewhere. Maybe I didn't talk to them. But I'd say that's towards the bottom. Then for a small period of time, I ran some ads on LinkedIn, advertising our passive investing guidebook, which we have a 100-page PDF that goes through just so much about investing in real estate from like a passive investor lens, like how a waterfall works, different risks to look for in a deal, how to vet a sponsor, how to evaluate a deal, a glossary of terms, like I said,
we'll link that in the show notes.
Yeah, so you can, or it's just breneman.com/downloads. It's there, and you just it's like a free download. And so that was the giveaway. But you get these leads, but they are very cold leads. So like they don't even remember downloading it, or were confused what they were looking
hammered at 11 p.m. Yeah.
Yeah. So I don't know if we ran into those or no. But I was, so, we met some investors through that, but really like, the bulk of the investors I have, it was referrals from this initial group of people that then I met in the real world. So it's really just meeting people in the real world still, and then referrals. So even I've tried all the other stuff, writing on Twitter and LinkedIn and all these places, but it's, and people do come in that way, or people schedule calls or sign up, but it's, the bulk of it is really is referrals. So I think if thinking about it, how I've thought about it, even, I know I've been doing this almost 20 years now, but I really haven't been trying to find new investors except, until like the last 3 years, really. Like I had a hard enough time, I feel like, deploying the money I had in really great opportunities. I wasn't spending any time on capital raising. Like I knew how much money we had to reinvest, and then it's okay. We just got $1 million back from those 2 refis. Let's say, well, now I know I have $1 million to deploy. It literally never crossed my mind to be like, why don't we go raise more money? And I never did it.
Yeah, it's always funny looking back. Like I look at all the stuff in And like over my career, I'm like, that would have been really smart if I would have known what I was doing. Like it's fun. So
yeah, no, I know. Or, from 2009 to 2019, I bought everything that's between $2 and $8 million. I just never thought I could go bigger than that. At least there, like we didn't have the equity, like I'm saying, like at that any given point to exceed that. Then I met another investor, and there was that $13 million deal I was talking about, and it was $3 million down, and he was like, "Yeah, sounds great." So then I'm like, okay, well that was easy. I just raised all the money with one guy. It took 10, 12 years of work to get to that point, but to have the deal and be able to get it, and then have everything, where you present it, and the guy you're pitching it to says, "Yeah, you've done this already a dozen plus times." Like, I'm in. But yeah, so no, the way I think about building the investor network is really even, I'm starting to get into, even though I feel like I've been doing this a while, I'm still trying to build what I feel like is like that base of investors that's what's going to really, really multiply, and not from like some tech, or like marketing strategy. It's more just like you have a dozen investors, you do a good job for them, they're pleased, they tell two of their friends, okay, now you got 36 investors.
36, yeah.
Then, another 4 or 5 years go by, and I got 100. Like it just can snowball like that. And when I talk to these people that have like 1,000 investors, I mean, some of them are young and they have, whatever, the best marketing program ever or something. Yeah. No, yeah. But it's a lot of them, they're like 60 and years old. And it's like, they had their first investors, in 1970, and just kind of grew it. So I'm just doing that. And that's the other thing with the deals we buy. It's a lot longer term holds usually than probably most folks. I mean, for us, we still own a lot of the deals we bought in 2009, 10, 11, with not really like any plan on selling those anytime soon. Even the ones we raise money for now, it's a 10-year hold is what we tell people. And then with some of the people that come into these deals, I could see where they're going to be like, let's just keep it. Assuming we're able to refi and return that initial capital, I think if people look at it just objectively and go, okay, I got all my equity out, I just have my profits left in it, I can go take my original equity, invest in another deal. And then if I don't sell the first one, there's no tax, no capital gains, no depreciation recapture. That sounds pretty good compared to let's sell it, I'll pay the taxes, and now I'll go into one other deal. Why not keep the first deal if it's still a good property, pull out your money, and then go buy a second one, no tax event, and no transaction costs in terms of first selling. I mean, so it makes a lot of sense. I think to hold longer than a lot of folks, send around deals to passive investors, or, people want to, put up high returns or earn their promote or whatever. But like the best, a lot of the wealthiest people I see doing real estate, they have like a way simpler strategy than like these shorter term flips. I bought a deal from a guy who, his dad bought 40 or so duplexes in the Lincoln Park neighborhood in Chicago, which back when he bought them in like the 70s, those would have been like 10,000 each. Now they're all worth $1 million each. And let's just pretend they didn't do anything else, and they did other things, and they reinvested the money. Let's pretend they didn't, and they got them paid off, and then there was cash flow. I mean, what do you think they made on that? 40, 50, $60 million? I mean, like that's...
Yeah. What's the IRR on that? Like, who cares? Yeah.
Yeah. Yeah. And they would be able to calculate it, but some of these other folks that I've saw, they wouldn't even, they never bothered learning what IRR was. And, wasn't a metric that people used before like Excel was out, potentially. I don't know what they were doing in the 70s for, returns.
It was a back of the napkin. It's, I don't know what else you could do. So.
Yeah. I think people were way more just focused on where you're going to stabilize it to. Yeah. Like today. Yeah. And that's enough of a spread.
I think that's where we're going to go back to though. Cause you had this short-term business plan and call it 2016 to maybe 2022, where if you bought it and you did nothing, you could even have net operating income go down. Cap rate compression would bail you out and you'd save it and you'd make money. I don't know if we can ever plan on that again. Just cap rates compressing to such a massive degree that you just print money. And I think a lot of the future income that people make from investing in real estate is just that long-term compounding. So at least that's what I keep telling myself when I structure these long-term holds. So
I mean, that's a great way to look at deals. And I mean, one of the reasons I got going in Phoenix was in Chicago, we didn't really have that much cap rate compression. I mean, I think in like 2013, probably average cap rate was a 6. By 2020, it was like a low 5, mid 5. Whereas, I mean, in Salt Lake, it's probably a lot different where you're at.
Yeah, it was like 3 caps. I was like, what is going on?
Went from a 7.5 to a 3. And because I know I heard someone on a podcast once talking about like prices on apartments in Dallas. This was in 2020. They're thinking about the next decade. And the guy was like, yeah, well, values tripled and rents doubled. That's probably not as good as that. Probably just both double. And I was like,
yeah, exactly.
All right. That sounds pretty good.
Yeah, plan on that. You'll do great. You're going to love it.
Yeah. So I was used to more just don't assume the market is just going to create a lot of your appreciation. Go in and just find these deals where the rents are below market, execute that plan, and then monetize it. And we were doing all these deals that were the Freddie SBL size loans. So you could get a really large cash out refinance. They would size a refi to a 120 debt cover and so you could, and back when there was good spread between your cap rate and interest rate, where interest rates were in the around 4%, and you're stabilizing these things. If you're normally buying at a 5 something cap, we're stabilizing it to like a 7 something on these. So a huge spread, able to refi out all the money on that. But yeah, those days are gone now. I mean, I'm talking about that like we have a lot of those, but I haven't seen one of those in a minute. Even in our last deal, we were projecting doing a cash or refi when that 5-year initial loan's done. But I think we made a table, and it was just the range of outcomes was like refiing out. I guess the table had anywhere from none of your money to 100 just to show all the range. But like if interest rates were 5.35, it was like a 75% cash out. So then like that's
great.
That sounds great. And then you pay any pref that hadn't been paid and return the capital. And then you just do another 5-year loan and then do the same. And then you just have your profit left in it and try to keep the taxes and costs down for everybody. Because one thing too, I mean, I think a lot of this like focus on IRR and what have you, it comes from like the institutional world, and most of those investors, they don't pay tax and they're running a fund.
Yeah.
So, because these are pension funds.
And they don't, They don't know how to operate real estate, so it's different. So yeah,
but they, if you don't pay tax and you got a 5 or 7 year fund, you just want whatever the highest IRR is going to be. You're not thinking about the time, the taxes you have to pay because you don't have to pay them, and then so I think that's where this sort of focus on that comes from. But if you're an individual, you have different considerations in a pension fund. You are paying tax and you don't have a whole investments team working on this. Maybe you won't be able to redeploy the money that quickly. Because I see it happen pretty frequently. Someone will get in a deal, they'll sell it early in like year 2 or 3. They'll make a high IRR, but the multiple is pretty low. It's only a few years. And then they pay tax. And then a year goes by, they haven't found another good deal. And it's like, now you're 4 years into this and you might have made it 30 IRR, but you're like actual multiple at that point, it could be like 1.5 at that, and you're 4 or 5 years in.
Inflation adjusted, it's like a 1. Like it's the same thing. So we were talking before the show about kind of marketers versus operators, and I actually didn't know that you have in-house property management. So I want to dig into that a little bit. Question number 1 is, were you always in-house, or like at what point did you bring property management in-house?
Oh, I've done it every way you could do it. And so, starting out from square one, the first properties I bought, I managed it like me. Like I did everything, accounting, paying the bills, leasing, showings, everything, going to court, whatever it was. And then, and so I think for someone starting out, like that's what I'd recommend. Like there's actually really not any role I haven't done, because also then I've done turnovers. I've changed flooring, cleaning, painting, just everything, doors. And so I think that fortunately my dad is he's retired now, but he was a tech ed teacher, so he would taught like woodworking and automotives and stuff. So I didn't know how to do any of that, but he did, and could just be like, here, hold the door, let me do it kind of thing. But so he on those ones, because those first deals were only an hour from where I grew up. So he helped when we had the turnovers, because it's a student rental, so you're turning over the whole building. But anyways, no, I started out like that, and then eventually on those first round of deals we bought in Minnesota, we managed them all ourselves. And then when we got going in Chicago, I was the only person living there out of my two partners, and so then I started managing the first three, just me again. And then once we got the fourth one going, I hired a friend of mine to manage, but like under our like umbrella. So he wasn't like technically an employee, but we were just paying him like a flat fee to be our property manager, leasing. And then eventually we got too big for that setup, and then we started hiring third party. And then this is in Chicago, and we were getting the same results from the third party as our own management for the most part. We were still able to get, let's say, what we needed. We were able to hit the rents we needed. A big thing in Chicago is getting your leases to end at those prime times. So it's a pain, because you got all these leases, let's say they end in January, February. You got to go to every unit one by one, like, hey, you want to do a 3-month extension or a 15-month renewal? And then they don't want to. And this is absolutely critical on these deals. So if your property manager's like, yeah, they said no, I don't, so I just renewed them for 12 months. Like, you can't, for the deals we were doing, we couldn't have used a company like that, but they were able to do 95% of what we were doing. And so that was good enough in our book. And then at a certain point, they started dropping off, and one of the larger investors I had, his son-in-law, was getting active in our business as well. And we're like, well, and why don't the two of us start a property management company? Then he can be the point person to run that, and then I'll just continue on the acquisitions, asset management stuff on my end. And so then that's when we brought it all back in house again in Chicago. But I think what's the most important is like being able to execute your business plan, where I think, and you can do that sometimes with a third party, sometimes with your own company, and sometimes not with either one. I mean, I buy deals all the time that are self-managed, that are ran way worse than your average third party manager. And then other times I buy deals and I'm like, wow, this thing was ran quite well. Just they didn't push rents. And so I think it can be done either way. I think the most important thing is just executing your business plan, and then who's making these decisions to keep it on track. Like for the most part, I still set all the rents, me or one other of the acquisition guys, all the rents on every renewal still, on the new leases. And it's pretty tedious, but it's one of the most important decisions we can make. And I am highly incentivized, being an owner and on getting to promote on many of these deals, like to push, where if you're doing the actual showings, it's kind of exhausting, and you're pushing for that last $100, and like, so your leasing agent is not going to usually tell you like, hey, I could have got $100 more, let's try it on the next one, because that might mean they got to show it 10 more times in the next one. So you need to be looking at it, or somebody does, your asset manager, somebody on the ownership team pushing that. So I think that's I know I just went a lot of random directions there, but I think that's the most important thing when I think about property management. And so I think as long as you're getting that, I think it's fine how you're doing it. But if you're not, if let's say you're buying a deal and you say, I'm going to be able to renovate it in a month and then rent it out another month, and it's taking you 4 months to do that instead of the 2, it doesn't matter who's your manager. Like, that's not working, whether that's your own company you're going to have to fire or a third party. Like, so as you need to be able to get the result. And so that's what we've been focused on. And then in Phoenix, we spend all third party management, but we've been able to get the results we wanted. I mean, the rents have fallen and the cap rates have gone up, but we've been able to be on track with like all of our renovations. We've been actually under budget, believe it or not, on those deals. So that's because we're controlling the renovation. Like, we're the ones, we don't just like farm it out. We're making all the decisions and arguing with people and whatnot.
So you're setting the rents, you're running what else are you personally involved in, and what do you delegate to your team?
So our setup now, I have 2 acquisitions guys and then 1 asset manager. The asset manager is he's doing all the investor reporting. He's because also we we're doing like 40 tax returns a year. We obviously, we don't fill them out ourselves, but like just getting the information to our CPA, reviewing them, distributing the K1s, like that all takes a lot of time. So he's doing that. He makes all the budgets. We have a expense database where we have every property that we own going back since when we bought it to 2009, if we owned it back to then, in an Excel spreadsheet where we typed in every financial, like an annual financial by line item for every deal. So it was extremely tedious, but something we did during the pandemic. And so we could tell you, like in Chicago, what we've been running on like these building types, like for per unit R&M or turnover, like since the beginning of time. So like we have, he's maintaining that, because that's been a really powerful tool for us. Because these, believe it or not, these deals, expenses are higher than like the brokers are telling you. So
you're kidding.
Yeah, I know.
It's news to me.
It is, brokers are great. They're salespeople. So why would they, tell someone like, hey, normally I'm seeing, like R&M higher, you should like raise it. Like they're not going to do that. They want to sell the property.
Like, these sellers, these guys are idiots, but you're smart. You like money. You like making money. These sellers, they don't like making money, but you're going to love it. So buy it at a 5. So.
Yeah, that sums it up nicely. Yeah. So I think, so he does that and a million other things. I mean, running distributions, that then they go into our bank, and then I approve them. And then the acquisition guys are, for the most part, they're the ones talking to the brokers. They underwrite the deals. And then if something is, we're getting close, then I'm getting involved, and then I'm going, hey, let's look at it this way, or this, let's assume a different kind of loan, or, okay, we have it as a 10-year hold. It looks a lot better on this 7-year plan. Let's, we could present it that way. So then, they're doing all those functions. And then what am I spending most of the time on? Yeah, it's just dealing with problems. Like I used to, it's, just this, as you get more properties, and more people working for you, there's more just issues come up. Insurance renewals, property tax appeals, just all sorts of things.
You get all the fun stuff.
Yeah. All it's, things don't, hey, this thing didn't add up. Like what's, and then it's, you're the, at the end of the day, like the main problem solver, all the buck stops with you kind of thing. But it's, so no, just whatever, and also too, I mean, when we're buying a deal, these, the acquisitions guys, they are great at bringing in the deals and underwriting them. But then once we get going on buying a deal, then I end up, I'm really involved, because then they haven't done that much on some of the more stuff like reviewing contracts or some of the due diligence stuff. They've all gone to all the physical inspections on every deal since they've all started working here, but I've gone to like 50 of them. So it's more there's a lot about construction that then I guess I have the knowledge on at this point, just owning these buildings and seeing these problems and knowing what that is, or because buildings have a lot of physical issues that then you got to deal with, and I've learned about over time. So then I like our contractor might say something, and then I'm like, oh, okay, I already know what that's going to entail, and it's going to be $20,000. And then the average person is like, what does that mean? And I'm like, it means it's $20,000. Like, or it's like, I already know. Or someone told me the other day, and I mean, maybe this shouldn't be taken too lightly, but where our sewer was broken potentially at a deal, and they were really kind of like nervous about telling me, is this kind of how the delivery was? And we were thinking like, well, who is this? How does it work when it's in the street in this city? Like I haven't had one happen here yet. And like, where it's like, this is like the 7th time this has happened to me, like where it's not new, but so like, let's just, who pays? Every city is different when it's in the street. In Chicago, you pay unless it's a house. If it's a multifamily building or commercial, you pay, and you got to pay them to work in the street. But so, this was in Tempe, Arizona. I didn't know. And how it works is the same as Chicago. Like, you need to do it. It's not, we were able to just clear the line, but it was where they were really like, so it's just, just a lot of that kind of stuff. And then, we don't have like a full-time marketing person. So then there's a lot of just like marketing functions that fall to me. Any kind of strategy, what markets to be in, what deals to pursue. Like in terms of when I was explaining our buy box, like that's the kind of stuff I'm thinking more about, where I don't want to be I think the strategy that people employ is that's oftentimes that, and maybe your team, is that's the most important decisions you can make. So, I mean, just people could be in real estate, and if you had picked office the last 10 years, you're singing a different tune than the people who picked industrial and multifamily.
Yep, exactly. I actually think about that a lot, like how my future would be if I was an office guy. Probably not too bright. So where you've got 200 something million dollars, I always lose track of this, but 200 something million dollars worth of real estate. Where do you want to go over the next 5, 10, 20 years?
Yeah, I don't really have goals like that, which maybe I should. And so I think what I've always focused on is I just really want to do good deals. I just really like the craft of going and just having a deal go well. I mean, honestly, the deal I like the most is I bought this 6-unit just on my own in 2017, and I don't know what happened in that deal, Tanner. Everything went right. Like every decision I made was like that was perfectly right. Or I bought it when I got under contract. I applied for a zoning change immediately to add a unit in the basement, turn it into a 7-unit. As I'm literally at the community meetings before I even bought the thing, and then I get the approval right as we're buying it, pull the perm, like everything went just so well. And then, I think I was all in for that on like $1.7 million. It appraised for $2.2 million. Put a $1.8 million loan on it. Like, I'm like, wow, this
beautiful.
is, yeah, everything we did.
Life is
like,
good.
Oh,
yeah.
Maybe we could improve the upstairs units a little bit, raise the rents to $2,300 on these units, and you rent them for $2,600. Like, wow, this deal is incredible. And so I really just want to do good deals. I don't have any size goals, volume goals. I think we did set something internally. We think we can hit. Where I think realistically for us, we could buy 80 million of property a year. And that's what we have set as an internal goal for 2024. We bought $36 million last year, which is really tough. And for 18 months, we didn't buy anything, but then had 2 deals at the end of last year. But I think, it's just all about doing good deals, for us. So I don't know. And if we end up buying nothing this year, that would be fine with me. I think on these deals, I always think like, if you're pushing a deal, like you're doing like a disservice to everybody, where even if you think of it selfishly, like, okay, if you get paid, you get a promote over 8%, let's say pref, and you're pushing deals and you don't make 8%, you're just wasting time working for free. Like I don't, even if you want to think of it selfishly, like it's not even in your interest to push, let alone it's horrible for the investor. Like if you can't beat the stock market, you would have to wonder what's the point. So you shouldn't beat us out here pushing deals, or taking on things that just don't make sense risk wise. Like right now is not a big time to be taking risk. Like the kind of deals we're doing, it's everyone and us included is shifted to like safer deals and structuring things with fixed rate debt, more money down, just because why not de-risk it? So because I think if you can make numbers work now, you're going to look back in 2024, 2025, it's not going to be that different than how people look back at 2009 and 10 and 11 and go like, wow, that was such a great time to buy. It was hard as hell to buy in 2009. Like we were the only bidders on a lot of those deals and had to do bank loans that were full recourse, because there's no equity, there's no lenders, it was really tough. But if you just think of it like as simply as possible right now, like the market, like prices went down, depending where you are, 10 to 30%. Why would it not be a good time to buy if things go up and down?
Yeah. I love it. Well, I have a hard time imagining you won't buy anything in 2024. So we'll get you back on and we'll hear how you bought 100 million or something. So cool.
Let's hope.
Drew, this was fun, man. Thanks for coming.
Thanks, Tanner. Appreciate it.